Real estate investment practice problem using Excel. Adjustable rate mortgage or ARM, no caps, part 4. Get ready because we're raising the stakes with real estate. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we have 3 tabs on down below: the example tab, practice tab, and blank tab. Let's take a look at them now, starting with the example tab, in essence being an answer key. In prior presentations, we put together the fixed rate amortization table so that we can compare and contrast it to the ARM or adjustable rate. Then we moved over to the adjustable rate, started to build our table comparing the index, which is the index on which our rates will be based as they adjust, noting that as they do adjust, we're going to think about a projection into the future and guess what the index would be. And or as time passes, we would know what happens in the index over time. So we want to think about it generally from a projection standpoint when you're making a decision as to what type of loans to be taken on. We then calculated our rate based on the index. We made a nice little chart down below, a graph, and then we calculated our payments based on this information, calculated the ending balances 2 ways. One, from the amortization tables themselves, looking up the ending balance, for example, 99,165 equaling the 99,165 here, and we did so with a formula so that we can do this all in basically a worksheet format as well. Now we're going to be moving on to the cash flow, doing a cash flow calculation, and then we'll create the pivot table, and then we'll talk about our tools for the internal rate of return and so on that we might put together when making decision-making processes about these types of loans. Going to the next tab, the practice tab, we got the blue areas, which is where we can populate our information with pre-formatted cells, making it a little bit easier to work through the practice problem if you so choose in that format. Third tab, the blank tab, where we will be on now. We've constructed this table in the past. We started constructing basically our table up here related to the adjustable rate. So we had our index rate column. This is what we're going to assume the adjustments will be on a year-by-year basis to the index. We then based our rate on it with a margin of 2%. So we got this nice graph showing that spread of what's happening between the index and our rate. We then calculated the payments and ending balances. Ending balances, as we said, calculated 2 different ways. Now we're just going to calculate the quick kind of cash flow, which we can kind of add into our table here on a year-by-year basis. We'll do that first. I'm going to do the cash flow. I'm going to start the cash flow this time a little bit different than the prior tab. I'm going to make the cash flow positive. So assuming we got $100,000 basically loan up front, we got the money, and then we took that money and we gave it to the seller. So from a loan standpoint, we got $100,000 cash inflow in essence that we then used to buy the home. The cash outflows then would mean that we're going to pay $733.76 per year for all of year 1. That means there's going to be 12 payments. I want to represent that over here in a negative cash flow to show it as an outflow. So I'm going to say negative of that cell times 12. And we copy that down, but let's do it one more time. This is going to be negative of this cell, the payments. That's going to be 12 payments of $1,023.73 for year 2. So times 12, and that'll give us our 12,285. I can copy that down, putting our cursor on the fill handle, dragging down. There's our yearly payments. Now, when I calculate the IRR, if I'm saying this is at the end of year 5, at that point in time, I need to add the loan balance to the end here. So I'm going to double click on this one, and I'm going to say there's that minus, we also have this 97,732, enter, meaning if the loan was done or we paid off the loan at that point in time, we'd make that payment, the 12 payments, plus we'd have to pay off the 97,732 at the end of that period. Now we got a nice quick IRR calculation we can calculate, which is the internal rate of return representing the rate at which this series of payments now would be equal, giving us like our approximated rate. Now note this is an approximation because we're basically taking our yearly payments here, and when we calculate the IRR on a yearly basis, it assumes that the payments are happening at the end of the year. That's how basically it works, when in actuality, they happen on a monthly basis in equal intervals, 12 months throughout each year. So it's a bit of an approximation, but it gives us a good starting point. So this is going to be equal to the IRR. Also, of course, if you were to look at this in terms of an estimate in the future, it's all an estimate anyways. So the fact that you might have a little bit more of a non-exact number here than taking the monthly amounts may not be much of a difference, given the fact that you're already dealing in the world of estimates if this is happening before the fact, so we can make decisions. So anyways, brackets, we're then going to take this series of items, closing it up. It's already on a yearly basis, so I don't need to multiply times 12. There it is. You can make it a percent and add decimals if it's not already in a percentage format. So we're looking 12.45. So that means that throughout this loan for 5 years, we've had rates of 8%, 12%, 15%, 17%, 12%, and average, not really average it, but it gives us the weighted average kind of, I guess, would be the 12.45, the percent at which the actual series of payments, assuming yearly payments, would be 0. You could try to calculate the average over here, but that's not exactly accurate because, it'd be just to calculate, just to get an idea, the average rate, you could say, it's been 5 years and we had a rate of this, so it'd be equal to the sum of these brackets divided by the number of years, or 5, making that a percent. So we're looking 12.8, fairly close in that case. But again, usually you'd want the IRR would be the calculation you would generally want to go, especially if you're not dealing with yearly kind of intervals, meaning you might have, a rate for multiple years, or there could be some other separation between the rates. So usually the IRR is what you're going to be looking at. Okay, so now it's going to be add our pivot table, which can be another nice tool because that can give us our cash flows on a yearly basis as well, and also group up, the payments in that format. It gives us a similar format as this table over here, but a little bit more detail, and it gives us an ability to adjust the table quickly by adjusting the data in this table quickly as well. So let's practice adding that, and then we'll take a look at our other calculations for an IRR on say a monthly basis instead of this kind of quick calculation here, which could be useful for decision making. So we'll first make the pivot table, go into the Insert tab up top, making sure we're on this table, and just add the pivot table. I'll do this fairly quickly because we've seen this concept in prior presentations. Adding the pivot table, I'm going to put it in the existing worksheet, and we're going to put it up in cell, I'm going to put it in cell AB1, and OK. So there we have it. I'm going to scroll on over to our information, construct this. I'll make this cell a little bit smaller. We're going to make the years. That's going to go into the values because it's a value. I'm going to drag it over into the rows. So now we got 30 years. Then I'm going to be picking the payment, the interest, the loan reduction, and loan balance. So there we have it. Let's format those, selecting the drop-down value field. We're going to number format this thing. Number format currency, brackets, $, none, no decimals, okay. Next one, interest. We got to value the fields. We're going to say number format, currency, and brackets, $, gone, no decimals, okay. And then the next one, let's do it again. Value, field, number format, currency, brackets, no $, no decimals, okay. And the last ones, we got that twist on it. There's a twist on this one, the balance, value. This one, we want the minimum balance to get the minimum balance for the balance at the end of the year. Then number format, currency, brackets, no $, no decimals, okay. And there we have it. Let's do some formatting on these cells. We'll make this, put some brackets around this thing, do some bracketizing, some brackets font group, make it a bracketize it, and then we're gonna make it black and white on the header, just because that's what our thing is. That's how we do stuff. That's how we've been doing it. Black and white on the header. Let's wrap the header. Alignment, wrapping the text, center the text, and then let's squish it together. Selecting the columns, putting our cursor on the edge and squish them together. Not too close. You don't want them to be shouldered to make them uncomfortable. So there we have it. And then maybe we'll make this bolden it. And then let's center this whole thing. So there we have it. So now we got this broken out on a year-by-year basis, going out 30 years, even though we only have 5 years of data. So this 5 years of data here are similar to the 5 years of data we got over here, except we got the payment and the ending balance. Over here, we got a little bit more information in that we've got the payments, we've got the interest, which could be a significant factor because we might be doing projections on tax implications and whatnot on a year-by-year basis as well. So it'd be nice to have that on a year-by-year basis. The reduction in the loan balance and then that ending balance, the loan balances, these then should be tying out to the table. So if we're trying to make projections on where we will stand given different scenarios, then it could be nice to build these tables. In other words, you could start with just this table right here, which gives you a pretty good layout, but I would still think it would be nice to have the amortization table to give you a double check that you're verifying things properly. It also gives you the ability to then do your IRR calculations on the monthly cash flows instead of the yearly cash flows, and then possibly have your pivot table over here, which gives you the year-by-year breakdown for the whole time frame as well, which again might make it a little bit easier to pull numbers for projections on things like interest or tax implications and that kind of stuff. So in the next presentation, we'll do one more here on this one, and we'll just think about the IRR calculation the way we've seen it before, constructing it on a month-by-month basis, and see what that could be using those same tools we've seen in the past, so that you might be able to compare different scenarios with different adjustable rate loans, because again, we don't know what the index could be. So you can try to think about what if analysis and try to give worst case, best case scenarios, as well as possibly comparing it to other loan structures.